Yes, today we are going to be dissecting the concept of working capital management, a very interesting and practical topic in finance. All right. Every financial um, person, or whether you call it financial analyst, finance manager, finance director, or CFO, you should have deep understanding of working capital management. It's a very important one for that matter. And so the syllabus require that you should have your understanding of working capital management. All right. So what do you understand by working capital? Because there is difference between working capital and then working capital management. When you talk about working capital, it represents the difference between current asset and current liability. All right. Working capital represents the difference between current assets and then current liability. It is the amount required for the day-to-day running of a business. Okay, so working capital is the amount required for the day-to-day running of a business. Businesses, whether small or big, requires working capital to be able to function optimally. A company will require working capital to pay salaries, right? Working capital will be required to purchase inventory and other supplies. Again, company will require working capital to settle short-term financial obligations when they become due. So if the company is unable to satisfy the financial requirements, there will be issue. The going concern of the business may be threatened. You can imagine if a company wants to pay salary and is unable to do so, what will happen to the reputation of the company? What will happen to the workforce? The workforce will not be happy, right? And then they are going to grumble because they also have their own financial obligation to settle. They have expectation that at the end of the month, they are going to earn their salary to be able to carry out their personal things. But if the company fails to pay, you can imagine what will happen to the business. All right. A company wants to buy inventory that is going to use to sell to be able to earn contribution or profit, but the company does not have the required working capital to purchase. What do you think will happen? There will be crisis in the business. And that's why you must ensure that you manage your working capital effectively so that a company can be liquid enough to be able to undertake or to carry out the business operation. So for you to know the importance of working capital. Now, there is difference between working capital and then working capital management. So like I said, working capital represents the difference between current asset and current liability. On the flip side, working capital management can be described as a judicious and efficient management of each component of current asset and current liability, including inventories, cash, prepayments, uh, account receivable, and account payable. So the effective management of each component of current asset and current liability in order to ensure the organization's liquidity. That is working capital management. So as a responsible organization, you must be able to manage your inventory. All right? You manage your inventories. You must be able to manage your account receivables. right? You must be able to manage your cash and cash equivalents. A company must be able to manage account payables. Until you're able to do this, that is when the company will be able to be liquid and have confidence that they'll be able to earn profits from the business. So that is working capital management. I repeat again, working capital management is a judicious and efficient management of each component of current asset and current liabilities, including inventories, cash and cash equivalents, accounts receivable, prepayments, as well as accounts payables, in order to ensure the organization's liquidity. So each component of current asset and current liability, the company must manage them independently and efficiently. How do you manage inventory? How do you manage receivable? How do you manage your cash and cash equivalents? How do you manage your account payable? All of these are what we want to discuss. Now, the key purpose or the primary purpose of working capital management is to ensure that an organization is liquid. That is, the company has sufficient cash flow to meet short-term financial costs or operating costs, and then short-term debt obligation. That is, when you say you have sufficient cash flow, your cash flow simply means that you are liquid enough. All right? Liquidity is the ability to settle all your financial obligations. For example, you want to pay salary, you have money to pay, all right? You want to buy inventory, there's money to pay, to use to buy the inventory. You are owing somebody short-term debt obligation. In the next 1 month, at the due date, you have money to pay. This is liquidity, right? So the primary purpose of every business organization is to ensure that the company always maintain sufficient cash flow to meet short-term operating costs as well as the debt obligation. Because efficient working capital management should ensure that a company operates smoothly, and then we should help to improve earnings and the profitability of the business. So this is introduction to working capital management. Let's talk about working capital cycle. Let's talk about working capital cycle. Now, when you talk about working capital cycle, it simply represents the length of time between when cash is paid to acquire raw material and when cash is finally received from debtors through sales. When you want to produce, you are going to need raw material. This raw material will be transformed to work in progress. Work in progress will be converted to finished goods. Once you have the finished goods, you put it in your warehouse or in your store for the purpose of sales. Therefore, customers will come. They will buy the goods either on credit or on cash. Whichever way, at the end of the period, you are going to receive your cash back. So you want to know, how long will it take you as an organization to spend money to purchase raw material and for you to be able to recover your money back? That is the cycle we are talking about. So I repeat again, working capital cycle represents the length of time between when cash is spent to acquire raw material and when cash is finally received from debtor through sales. The shorter the working capital cycle, the better for the organization. All right? So the shorter the working capital cycle, the better for the organization. If working capital is longer or is dragging, it means that the company will be tying down capital. Capital will be idle. You are going to tie down money. And that's why you have to manage your working capital to ensure that the cycle is shorter enough for you to be able to be liquid. Otherwise, you can imagine the company has a policy that our receivable, our debtors collection period is 30 days, meaning that if customers are owing you, they have maximum of 30 days to pay back the money they are owing, the credit you have extended to them. So the company has responsibility to be able to ensure that they collect all the collectibles, they collect all the receivables as at when due. So if a company now, because a company is liberal or generous for that matter, they now allow the customer to delay payment. 30 days has passed, 30 days has moved to 45 days. 45 days is moving to 60 days, 2 months. That's not good enough. This will affect the liquidity position of the business. And that is why it is essential to ensure that you manage your working capital effectively for you to be able to maintain the liquidity position of the business. Because when you are tying down money, when you are tying down your capital, the company will not be able to earn return on the money because somebody is owing you somewhere. If your customer has paid the debt, all right, you would have used that money to invest in short-term marketable securities, or you can even use the money to buy another inventory for you to be able to sell. But because the person has not paid, therefore your money is tied down somewhere. So that's why you have to ensure that you manage your working capital effectively. So the quicker the cycle, the better for the organization. Now, working capital cycle can be drawn as follows. If you want to, in case examiner is asking you to explain working capital cycle, after you have explained by saying that working capital represents the length of time between when cash is spent to acquire raw materials and when cash is finally received from debtors through sales. The shorter the working capital cycle, the better for an organization. This is because if working capital cycle is longer, this will deny the company to be able to earn return on the capital. So, and then you then say this working capital cycle can be drawn as follows. You then begin to draw your diagram. The first item is cash. Let me show you where you are going to start. So to draw your working capital cycle, you start from cash. Remember, we said that working capital cycle is the length of time between when you spend money to purchase raw material. So you are starting from cash. From this cash, you convert the cash. You use this cash to buy raw material. All right? So this raw material is then transformed to work in progress. Work in progress will be converted to finished goods. Right? Then customer will come and purchase the finished goods. All right, so here you have debtor. If you like, you can call it debtor or receivable. All right, so once the debtor pay, once they pay, then they become, that means you have collected your money back. So that is the cycle. That is how you are going to draw it. So you start from cash to raw material to work in progress to finished goods, then finished goods to debtors or receivables. So that is the operating cycle. You can call it working capital cycle, operating cycle, or net operating cycle, or cash operating cycle. It's still the same thing. Whatever examiners call it, is still the same thing. All right. So that is how to draw the working capital cycle. Now, every company should establish working capital management policy and guideline. This policy is intended to ensure that the company is liquid. The company will be able to be liquid if they are able to manage the component of current asset and current liability effectively, because that policy will show the policy guideline, the organizational politics, policies and the guideline will dictate how a company should manage inventory, account receivable, cash and cash equivalent, accounts payable, and all of that. So, and then whatever the company has as a policy must be applied across all the organizations, So the guideline must be followed when you are preparing your inventory, when you are preparing your accounts management and all of that. You have to apply the guideline, because the guideline is just like as a roadmap that will show you how you should do things. So if the company has agreed, all right, because the policy and guideline supposed to dictate, supposed to show direction of how things should be done within the organization. So every company must have that. How do you manage your cash? How do you manage your inventory? How do you manage your accounts payable? How do you manage your receivable? You must have a standardized format of doing it so that things will not be done anyhow. So if the company is able to do this, then of course, in that case, it is certain that the company will be able to will be liquid enough to maximize profits. Okay. Now, let's discuss how to estimate working capital cycle. Let's discuss how to estimate working capital cycle. Let me see. Let me start with the format before I will define. Let me start with the format. I'm looking for a space. I don't want to use working note now so that we can cover as much as possible. Looking for a bigger space to do this. Okay, let's manage this place. Now, if you want to determine working capital cycle, you want to know how long it will take you as an organization to convert cash, okay, or to determine your working capital cycle. So you can, let's say it is our operating cycle as the heading. So you want to determine operating cycle. There are 5 components of operating cycle. An operating cycle is measured in number of days, right? So the first item will be number of days raw material is held in store, okay? Because of space, let me see if this one will be sufficient. Number of days raw material is held in store. So whatever it is, you post, like I said, is to represented in days. The second one is the length of time in the production cycle. This number of days raw material is held in store is called raw material conversion period. Okay, raw material conversion period. How long does it take you to convert raw material to work in progress? You know, you spend money to purchase raw material. That raw material, you kept it in the warehouse. Then you need to transform it to work in progress. So how long does it stay? How long does the raw material stay in the warehouse? That's your raw material conversion period. So number of days raw material is held in store. Then number 2 is the length of time in production cycle. length of time in production cycle. This is called work in progress conversion period. Work in progress conversion period. The work in progress from conversion period is the length of time in the production cycle. You want to know, you go to your warehouse, you pick the raw material, you take it to the factory, you want to convert it to finished goods. Before you convert it to finished goods, how long does it take you for you to turn the raw material to finished goods? So when you are in the production cycle, when you're in the production process, that is work in progress. That means the goods is still in work in progress. So the length of time in the production cycle represents your work in progress conversion period. Okay, so you add it to raw material conversion period. The third one is finished goods conversion period. The finished goods conversion period is the number of days finished goods is held in the warehouse before being sold. You know, when you finish production, you need to keep the finished goods in the warehouse or in your store before you sell them. Therefore, how long does it take the company to sell those goods after production? How long does it take to sell the goods? That's what is known as finished goods conversion period. That is the number of days finished goods is held in store before being sold. Okay, let me put it down for you. Number of days finished goods is held in store before being sold. This is called finished goods conversion period. So you had the fourth one is number of days credit is given to customers. This is called debtors collection period. How long does it take the customer to pay back? When you grant customer credits, how long does it take them to pay back? That is number of days credit is given to customers or debtors collection period. Number of days credits is given to customer. So I said this is debtors collection period or debtors conversion period. So you add the four of them together. That will give you gross working capital. This is gross. Let's call it gross operating cycle or gross working capital cycle. So from this gross operating cycle, you then deduct number of days credit is taken from suppliers. That is creditors payment period. So you less number of days credits is taken from suppliers. I said this is creditors payment period. Your supplier as a company, your supplier has given you credit. How long does it take you to pay back? All right. How long does it take you to pay back the supplier? That's your creditors payment period. So this is a minus, you less. So the difference between the gross operating cycle and the number of days credit is taken from supplier is known as net operating cycle. The difference is known as net operating cycle. Net operating cycle or net working capital cycle or net cash operating cycle, whatever you want to call it. All right. So these are the 5 components of working capital cycle. 4 of them are positive. Only 1 is a negative. So you have to know this. You have to know this. All right. So that's that. So this is the format. Anytime you want to calculate operating cycle or working capital cycle, this is the format that you should follow. So I've already explained each line item, but let me just show you in your notes. Yes, and then how to calculate them. So the next thing is to explain how to calculate the working capital cycle. So the first item, like I said, is the raw material conversion period. The raw material conversion period is the number of days raw material is held in store before going into production. You purchase raw material, if you go to the market to purchase raw material, you are going to keep that raw material in your store or in your warehouse. How long does the raw material stay in the warehouse before going into production? Before you start production, how long does it stay? So that is raw material conversion period. So to calculate raw material conversion period, you are going to pick the raw material given. You divide it with the raw material purchase. All right. So raw material divided by the raw material purchase, sorry, divided by the raw material consumed or purchases. So then multiply by 365 days for a year. All right. So that will give you the raw material conversion period. The next one is work in progress conversion period. We said this is the length of time in the production cycle. You go to the warehouse, you pick the raw material, put it inside the machine, then you begin to produce. So how long does it take you in the production cycle, in the production process? This is work in progress conversion period. So work in progress conversion period is calculated as work in progress over cost of sales, then multiplied by 365 days. All right, so this is the formula for calculating work in progress conversion period. The third one is finished goods conversion period, which we said is the number of days finished goods is held in store before being sold. After you finish production, you keep the finished goods in your store or in your warehouse. From there, you now sell, you now begin to sell in the market. So how long does it take the company to convert the finished goods to cash? All right. How long does it take to convert the finished goods to cash? Because you are going to sell it. When you sell the finished goods, you'll be able to receive money back. All right. So to calculate finished good conversion period, it is finished goods over cost of sales. Finished goods over cost of sales. Of course, all these numbers, depending on the question, at times examiner may want you to use average figure. At times it will just be the closing figure. That is the figure at the end of the period. All right. Then the fourth one is debtors collection period or debtors conversion period, which I said is the number of days credit is given to customer. How long does it take your own customer to pay back the credit you have extended to them? That is debtors collection period. To calculate debtors collection period, you are going to divide debtor over credit sales. All right, then multiply by 365 days. Okay. Then the last one is creditors payment period, which represent the number of days credit is taken from suppliers. So this will be calculated as creditors over credit purchase, then multiply by 365 days. Now, in a question, at times examiner can give to you 365 days for a year, okay? Or examiner can give you 360 days for a year. Whichever one that is given is what you are going to use. But in most cases, number of days for a year will not be given to you. So you are at a liberty to either use 365 days or 360 days. Whichever one that you have chosen, or whichever one that you have used, you have to indicate it in the question that 365 days or 360 days is assumed for a year, because you are not given 365 days. You are not given 360 days in the question, but you decide to assume any one of them. So you have to state your assumption. All right. So that is that. At this point, before we begin to discuss the remaining scope or other scope of the topic, let's practice. Let's have practical questions under working capital cycle. All right. Let's have practical questions under working capital cycle. Working capital management is a very long topic to cover, and there are a lot to learn. So like I said, it's very practicable, very practicable. Every day, even you as you are attending this class. If you don't, some of you, if you don't have, if you have incurred working capital for you to be able to join the class, imagine you want to join the class and you don't have data. If you don't have money to buy data, that means you will not be able to join the class. That will limit your capacity. That will limit your ability to join the class. You want to attend lecture, you don't have money to pay for lecture. That will deny you the opportunity. All right. It's the same thing for companies. A company that wants to pay salary, but the company is struggling, no money to pay. Then the management will begin to agitate because the pressure will then mount on the management. It will be so embarrassing to say you want to pay salary and there is no money. You can imagine that, you know. So that's why you have to manage your working capital efficiently to avoid anything that will erode your reputation. Yes, I'm looking for. We are going to solve about this one that has multiple years. Ah, this one will take time for 3 years. Okay, let's see. Let's solve this number 11. Let's solve this question number 11. Let's start from there. All right. Let me read for you. Or let me look at. I need one of you to read. Who is helping us?
Me,
Who will
I'll
help
read
us?
though. Hello. Hi.
Okay.
Good
Is
afternoon,
that
sir. Uh,
Kazin, Larry?
yes.
Okay. Oh yeah, read.
All right.
Other people, all of you should mute yourself apart from Larry. Go ahead, please.
Okay. So the working capital cycle of a business is the length of time between payment for inventory, entering into inventory, and receipt of the proceeds of sales. The table below gives information extracted from the statement of comprehensive income and the statement of financial position of Ballerina PLC for the years 2012 to 2014. Okay. You're required to calculate the working capital cycle for each of the 3 years. Explain 3 possible actions that might be taken to reduce the length of the cycle and 2 possible disadvantages of each.
All right. Thank you very much, Larry. That is the question. In the A requirement of the question, you are to calculate the working capital cycle for each of the 3 years. All right. So to do this, what are you supposed to do? Of course, you then go to the question, check the component of current asset and current liability given to you. Do you have inventory? Yes. Do you have do you have a raw material? Yes. Do you have work in progress? Yes. Do you have finished goods? Yes. Do you have receivables? Yes. Do you have account payable? Yes. That means the 5 components of operating cycle is there in this question. Therefore, I need to calculate raw material conversion period, work in progress conversion period, finished goods conversion period, debtors collection period, trade payable, which is creditors payment period. So once I'm able to do that, then that's it. So I will do for 2012, I will do for 2013, and then 2014. So quickly, let me stop sharing this and move to the working note. So solution to illustration 9. That's page. Let me check again. Page 114, illustration 11. All right. So the name of the company is Ballerina Limited. So you want to calculate. Examiner is asking you to calculate working capital cycle. So I would then say calculating working capital cycle in days. You want to know the length of time between when cash is spent to acquire raw material and when cash is finally received from debtor through sales. So we are to do for 3 different years, 2012 to 2014. So you can then say 2012, 2013, 2014. So the first item will be, if you like, you can say raw material conversion period, or you say number of days raw material is held in store. Number of days raw material is held in store. Whichever one you use, you are good. Number 2, you need to determine length of time. In the production cycle. Okay. Number 3, you determine number of days. Finished goods is held in store before being sold. Number 4, you determine number of days. Credit is given. Credit is given or granted to customer. Then number 5, before that, you are going to have gross working capital cycle. Then number 5, you then have number of days. Credit is taken from supplier. Okay, because of space. Okay, I can shift to the front. All right, then you have your net working capital cycle. So that's the format. Let me push this number of years to the front. Twenty 2012, 2013, then 2014. All right. So all I need to do now is to go and do my workings. Once I'm done with workings, then I will come and post. That's all. Minus, you minus that from the gross. That's all you need to do. It's very straightforward and easy to understand. So at this point now, we need to go and calculate number 1 to 5. So we can then start our workings from here. Working number 1, we want to calculate raw material conversion period. So we can put our working in a table as well. So for 2012, 2013, then 2014. I don't know the extent. So let's start from somewhere. So the first item will be raw material conversion period. And we said raw material conversion period represents or is calculated as raw material over raw material purchases. Raw material divided by purchases multiplied by 365 days. So we need to go back to the question and check. All right? We need to go back to the question and check the raw material given to us. In the 2012, raw material is 1080. Figures are in thousands. So examiner, you also need to check from the question whether you are asked to use average figure. All right. So examiner is silent. You are not told whether to use average figures or not. So if you are not told to use average figures, then just use what you have in the question. At times, examiner can tell you that you should use average figure. For you to do this, the one of 2012 plus the one of 2013, you add the two together, you divide it by 2. That will give you average figure. At times, examiner will give you opening figure and then closing figure. So to get the average, you add opening plus closing together to get the average figure. But in the question, examiner is silent. So let's just move on. So 1080 is raw material in 2012. So here is 1080. Let me push it to the front a little bit. So 1080 divided by purchases. According to the question, purchases is, we are given purchase 5184, 5184, 5184, then multiply by 365. In the question, examiner did not tell you whether you should use 365 days or 360 days. So you are at liberty to use either 365 or 360 days. So always use 365. So I will come here, multiply by 365. Therefore, this will give us what? 1080 divided by
76 days.
76.0, that's 76.
So 76. So you have to round your number. All right. You round the final number. So here is 76. Then move to 2013. What is raw material in 2013?
1458.
1458.
1458 divided by purchases in 7020 multiplied by 365. Give it to me.
76.
76 as well. Then 2014 raw material
180.
You said what?
18.
1,800.
Yes.
Then purchases
72.
7,200 multiplied by 365 days.
91.
91 days. So it takes the company 76 days to purchase raw material, and that raw material was kept in the warehouse. That raw material stayed in the warehouse for 76 days in 2012 and 2013. In 2014, it became worse. It's now increased to 91 days. This is not good enough. All right? But in any case, examiner did not ask you to comment on this, so let's move on. All right, so I can use this to then outline my table. All right, so the second one, working two, is work in progress conversion period, which is work in progress over cost of sales multiplied by 365 days in a year. So in 2012, how much is work in progress?
756.
756. What about cost of sales?
7,560.
7,560 multiplied by 365 days. What you get?
37.
37 days. Then in 2013, what's work in progress?
972.
972. Cost of sales?
9,720.
9720 multiplied by 365. What you get?
37.
37.
37. Okay. So here is 37. Then in 2014, work in progress?
933.
933. Cost of
10,000.
sales?
10,983.
983.
Yes.
Multiplied by 365.
31.
31 days. So that's that. Then move to the third one. Number 3, finished goods conversion period, which is calculated as finished goods over cost of sales. All right, multiply by 365 days. Let me outline my table here. Okay. All right then. So in 2012, how much is finished goods?
834. 864.
864. All right. Cost of sales is
7,560.
7560. Then multiply by 365. What you get?
42.
42 days. 2013 finished goods.
1296.
1296. And then cost of sales is 7,200.
Cost of sales. No, 9,000.
9,000.
9,720.
Yes. 9,720. Thank you. 9720. Final answer.
9,10,4. 49. That's 49.
49 days. 49 days. Then finished goods in 2014.
1,428. 1,000.
1428. divided by cost of sales,
10,983.
983, multiplied by 365 days. Give it to me.
47.
47 days. Okay, so that's for the third one. Then we move to the next one, which is debtors collection period. Number 4, debtors collection or conversion period, which is computed as debtors
1,000.
over credit sales multiplied by 365 days. So what's debtor in 2012?
1,728.
728.
Yes.
What's credit sales?
8,640.
8,640 multiplied by 365 days. What do you have here?
73.
73 days. Now, at times, examiner will tell you that, like in this case, examiner just give you sales. You are not told whether it is credit sales or cash sales. So if you are not told, then you are going to assume it is credit sales. Now, at times, examiner will tell you that out of the sales, 20% is cash. So if 20% is cash, it means that the balance of 80% is on credit. So you need to watch out for that. All right. But in this question, the examiner is just silent. So that's why you have to assume everything is on credit. Yes, 2013 debtors.
2,592.
592.
10,000.
Revenue
10,008.
800. Multiply by 3.
10,800 new. Okay, yes.
Right now you said 10,800. No be so.
Yes, yes.
So what do you have?
88.
88 days. Then in 2014, debtors
2,970.
2,970 divided by
11,000.
credit sales
11,880. 11,880. 880 times 360. That's 19.
Are you still there?
Yes.
What's the final answer for year
91, sir.
91.
91 days?
Yes. Yeah. Yeah.
Okay, so the final one, which is year 5, sorry, number 5, working number 5, we have creditors conversion period or creditors payment period, which is computed as creditors over credit purchases. Multiply by 365. In 2012, how much is creditors?
864.
Credit purchases?
5,184.
184.
Times 65.
Multiply by 365. Give it to me. What you get?
61.
Take it again.
61.
61 days. Then, creditors in 2013.
1,053.
Credit purchases.
7,020.
Multiply by 365 days. What you get?
56.
56 days. 2014,
1,260.
1260,
7,002.
7200.
64.
Final answer,
64.
64 days. So you have to show your workings. You just have to show your workings. So all what we have calculated now, we then need to go and put it in the format, in the table. 76, 76, 91. So here is 76, 76, 91. The next one is 37, 37, 31. 37, 37, 31.
Two to eight. The first one.
Then the third one, the working three is 42, 49, 47. 42, 49, 47. Number of days credit is given to customer. Debtors collection period. That's 73, 88, 91. 73,
Sir, the last one should be 92.
92.
The first one is 2 to 8.
What is 228?
The first one, 2012.
Is 22, is it not 1728? Debtors collection period. What is, let me check myself. Debtors
For
is
2012, the answer is correct, 73.
so which one is not correct?
She's
As
talking
in
about
the total. I'm talking about the total.
The total.
The total.
Which total?
2000
Gross
2014.
working capital cycle, the total.
I've not
Sir,
done it now.
2013 is not correct. 2014 for debtors collection period is 92.
2013 is not correct. For creditor payment period, 2013 is
I've
supposed
not
to be
even
55.
How is it 55? Then you round it up now. Is it not 56?
Not 56.
Okay.
no worries.
It's
Okay,
rounding up
let's
now.
do this. Please, I don't want chaos in my class. Only one person should be helping to give numbers. If I want to do another question, maybe I did not because I did not arrange for that. So let me settle with Temi for now. Let me settle with Temi to be giving me the numbers for this question. All right. Other people, all of you should then mute. I don't want chaos. Now, you only answer me when I ask you question. Temi.
Okay.
So in 2013, for debtors collection period, we have 88, then 91. Here is 88. Here is 91. So give me total for each of them. But somebody was saying that the 2014 is 92. Let me confirm myself. From my calculator, 2970 over 11,880 equal, then multiply by 365 equal, that's 91. That's correct. Okay, I think the person mentioned creditors payments. Let me confirm that too. 1260 divided by 7,200 equal, then multiply by 365 days equal to, no, there's an error here. 1260 divided by 7,200. Oh, okay, I know the reason. Equal, multiply by 365. That's 64. Yeah, it's correct now. So somebody is sending a chat. Let me check. Um, 2013, sir. CCP, it is 55. That is for 2013. In 2013, okay, let me check. 1053, 1053 divided by 70/20 equal, then multiply by 365 equal, that's 55 days, not 56. This one is 55 days. Okay. All right. So tell me, give me the
Yeah.
gross working capital for each of them.
228. 2009.
228.
The next one, 250.
215.
250, yes.
2014.
260.
260. Okay. Why is the 2012 so low? 228. Can you reduce? Okay. Yeah. So can you redo the 2012? It appears 228 appears so low for me. Tell me. Okay. Somebody has confirmed that is correct.
That is correct.
So let's deduct creditors payment period. So 61, 55, 64.
167.
61. Here is 64. Say it's what?
167.
7 days.
The
Next
other
one.
195.
Okay. 2014.
196.
196. So that's it. That's it. So examiner is only asking you here that you should calculate the working capital cycle for each of the 3 years. So you can see it takes the company on the average half a year to convert raw material to cash. It takes this company on the average of 180 days to convert raw material to cash, depending on the nature of the business. But this number appears too long. All right, it appears too long. But in any case, that's what the examiner asks us to do. All right, so you can then come here because we have used 365 in our calculation, and 365 is not given in the question. You can then say, note, 365 days is assumed for a year. That's it. So with this, I've shown the examiner that I use 365 days for a year. If it is 360, you do the same thing. All right. So number B part of the question, you are asked to explain 3 possible actions that might be taken to reduce the length of the cycle and 2 possible disadvantages of each. What are the possible actions that can be taken? All right. What actions can be taken to do this? I mean, to reduce the length of the cycle. So for you to be able to answer the question correctly, you need to speak about, you will speak about the each component. How do you reduce your raw material conversion period? What are the steps you need to take to reduce your raw material conversion period? Then you also need to comment on the step that the company can take to reduce work in progress. All of this is what the examiner is asking you. Let me use Golden Book to show you this one so that we can move faster. Let me see. Let me stop sharing this. Let me go to Golden Book so that quickly we can Okay, so in the B part of the question, examiner is asking you for the possible action that might be taken to reduce the length of the working capital cycle and their disadvantages. For those of you that have the golden book, if you go to page 330 up to 332 or thereabout, you see there. Now, how do you reduce? Remember, our raw material conversion period is on the average is about 80 days. It takes like 80 days on the average for the company to convert for raw material state in the warehouse for average of 80 days. Therefore, how do you then reduce? Who is this person writing on my screen? Then, how do you reduce the raw material conversion period? So, this is it here. Raw material, reducing raw material. The raw material required may be reduced to a smaller quantity or reduced to safety stock. All right. So instead of you to buying in large quantity, you can just buy small quantity. Instead of just buying raw material in large quantity, keep it in your warehouse and it now stay longer. All right. It should be dragging. So instead of that, why don't you just buy a small amount of the material that you need? Or you can even adopt just in time. You can adopt just in time so that what you need is what you are getting. You don't even need to store any raw material. That is your just-in-time system. All right. So what are the disadvantages? What are the disadvantages? If you buy small quantity or smaller quantity of the raw material, what are the disadvantages? One is loss of bulk purchase discounts. You know, when you buy in large quantity, suppliers can give you a kind of discount because you are buying in large quantity. But now that you are buying in smaller quantity, you are going to lose that discount. You will not be able, the company will not be able to earn the discount again. The second disadvantage, if you buy smaller quantity of raw material, is that there is a probability of stock out. Stock out simply means that you don't have the material. You can imagine you want to produce. You want to produce, then you get to your store. You discover that raw material has been exhausted. So you can imagine that will disrupt production process. There will be no smooth production run. So that is the disadvantage for you to buy in smaller quantity. The next one is increased ordering cost. The ordering cost is the cost incurred whenever a company places an order and when the company finally receives the order. So some of the examples of ordering cost is transportation cost. So you need to commute to the market, to and fro. You spend money. So because you are buying in smaller quantity, that means you are going to be frequent in the market. You buy maybe today now, you buy small quantity, you go to the market, you spend money for fuel and maybe from transportation. You come back again, the following day you go to the market, then you continue to do, you can imagine. So this will increase the ordering cost. All right. Then the next one is that it will hinder smooth production run because you don't know how much, you may not know, at times you may need extra for you to be able to finish a particular production process. So because you have limited quantity of the raw material, then once the raw material finishes, that means you have to stop production until you get the raw material again. You can imagine maybe it will take hours for you to be able to get the raw material, then for you to continue with your production. So these are the disadvantages that is associated with buying smaller quantity of raw materials. So like I said, another option is for the company to, instead of buying in smaller quantity, you can adopt just-in-time system. Just-in-time system simply means that you only place order when it is needed. All right, you only place order when it is needed. So in this case, there is no need for you to even store any raw material. If you know that you are going to need 100 kilograms of the material, you call your supplier, please, I'm going to need 100 kilograms of this material on so day. So it will be delivered. Once it is delivered to your factory, then you continue with your production. No need to store the raw material. That is just-in-time system. Then the second one, How do you reduce work in progress? Work in progress can be reduced by introducing advanced model machine that will bring about efficiency in production. You know, what is causing, when you look at our calculation, it takes the company on the average of 35 days, or thereabouts in the production cycle. It takes this company average of about 35 days in the production cycle. So how do you reduce this? Why is it taking longer in the first place? Why is the company taking longer in the production cycle? It may be that maybe the machine that you use for production is weak, or the machine has broken down. If the machine breaks down, then that will delay your production. That will delay the production. It will extend your production run. So to resolve this, what are you supposed to do? You can purchase advanced model machine that is capable of producing high quality and with efficient production. It will ensure there is efficiency in production. So what is disadvantage? What are the disadvantages associated with buying a new machine to produce? One is that you are going to spend money to purchase it. All right, capital expenditure required to purchase the new advanced model machine. You need money to purchase the machine. Then when you buy the machine, you also need to train the workers that are going to be using the machine. So the cost of training those workers or staff is not for free as well. All right, so the cost of training and installation of the technology will also need to be considered. All right, so these are some of the disadvantages that is associated with buying a new advanced model machine that have the capacity to produce high volume and good quality products. Okay, then the third one is finished goods. How do we reduce finished goods? All right, so when you look at our calculation, finished goods is on the average of about 45 days as well. Finished goods is on the average of 45 days. How do you reduce? That means the finished goods stayed in the store for about 45 days before being sold. So how do you ensure you reduce the number of days the finished good is stored or stayed in the warehouse? All right. So this is my response. Work in progress can be reduced. No, finished goods. Finished goods can be reduced because reduction in raw material and work in progress will also reduce finished goods, because finished goods is coming from raw material conversion period and then the work in progress for conversion period. So if the company is able to reduce raw material conversion period and then work in progress conversion period, certainly the finished goods will also be reduced. All right, the finished goods will be reduced. So what are the disadvantages to this? This may result in stockouts. All right, it may result in stockouts. Stockout simply means that you don't have the finished goods again in the warehouse, so you need to produce another one. You can imagine customer wants to buy. Your customers want to buy your product, but it's finished because there is a stock out. So the company will not be able to earn revenue after that. That can also result to loss of reputation. Okay. Again, there will be loss of revenue. There will be loss of, because you cannot sell. You have exhausted the finished goods. So there will be loss of revenue. So customer may also be, the company may lose customer to the competitors. So these are some of the disadvantages when you reduce your finished goods. And that's why we are managing your inventory to be able to know what is your inventory level, what is the maximum inventory level that you should keep, what is the minimum inventory level, what is the level at which your inventory should reach before you place a new order. All of this is designed to manage your inventory effectively to ensure that there is no stock out. So the next one, number 4, is trade receivable. How do you reduce your collection from the customers? All right. When you look at our calculation, on the average, our receivable on the average, when you add up the three of them, 73, 88, 70, 91, that should be around 80 or 85, between 80 or 85. I don't want to use calculator. So let's say on the average, the debtors collection period is about 80 days, right? It's about 80 days. Therefore, how do you reduce this? That means your money with customer stay for almost 3 months before you collect it. That's too long. It also depends on the credit terms of the company. If the 80 days or thereabouts on the average is consistent with the government, with the company's policy in relation to customers or credit terms granted to customer, then that's fine. But on the face value of it, this appear too long. Almost three months for you to collect money from customer. It appears too long. All right. So how do you then reduce? How do you reduce the debtors collection period? So this could be achieved by offering cash discounts. Okay, that's number one. The company can offer cash discounts, meaning that if you pay now, we give you 5% discount. So that may encourage customer to want to pay cash instead of buying on credit. All right, that's number one option. The second option is that the company can review the credit terms or engage the service of a debt factor. If you review your credit terms, if your credit term is liberal simply means you are generous. Your credit terms may be for, let's say, for example, 3 months. In fact, even after the 3 months, some customer will still be delaying, they will not pay on time. But because you are generous, you are Father Christmas. Because you are liberal, you just allow the customer, when they have the money, they will pay. So when you're in that kind of a position, certainly your trade receivable will be very longer. It will be dragging. Customer will not pay on time because they know that you are not going to stress them. You will not pressure them to pay. All right. So in that case, as a responsible organization, you need to review the credit terms. You review the credit term. If your credit terms is for 30 days, you can reduce it to 15 days maximum. You reduce it to 15 days. That means you want to tighten your credit terms. You want to tighten your credit terms. Or another option is that you can engage the service of a debt factor or debt collection agent. So instead of the company to be engaging the customers, to be pushing, to be chasing the customer to come and pay their receiver, to pay their debt. So the company will need to engage debt collection agents. So this factor, we call them debt factor. They are the company will sell it. The company will sell the invoice to the debt factor. So the debt factor will then be introduced to the customer. So going forward, the transaction will then be between the debt factor and then the customer. So that means the company has withdrawn. The company has withdrawn from the transaction because the debt that the customer is owing the company has been sold to debt agents, to debt factor at a discount. So going forward, the arrangement is now between the debt factor and then the customer. So they are the one that will use whatever means to ensure they collect the money from the customers. All right, so that is that. So what are the disadvantages to this? Number one is that cost of discounts. Because you are given discounts, that means your revenue will reduce. Because if, for example, your selling price is 100 naira, because you want customer to pay, you offer them discounts. So instead of you to collect, you offer this discount of 5%. So instead of you to collect 100 naira, you are going to collect only 95. That means your revenue has reduced by that 5% discount you have given to them. All right. So the next one is possibility of customer taking the discount and not making early payments. Yes, at times when you offer customers discounts, they will still not pay. All right. You offer them discounts for them to be able to pay on time. They will still delay for some days before they finally paid, giving a series of excuses. All right. Then the next one is that, of course, cost of collection in case of debt collectors. Because when you have debt factors to collect money on your behalf. Like I said, it's not for free. You pay them for their service. You also pay the invoice to be collected at a discount. You are not going to get the entire amount the customer is owing you again, because you are going to sell it to the debt factors at a discount. So all this cost you need to is something you need to consider. Then the next one is loss of sales. Because you have tightened your credit terms, customers may go to your competitor if they believe that you are too strict. If they believe that you are too strict, or your credit time is too tight for them, then they will leave you and go to your competitor. That may result in the loss of sales. So these are some of the things you need to consider to reduce trade receivables. And the last one is trade payables. When you look at our calculation, on the average, it takes this company, it takes Ballerina on the average about 60 days to pay back suppliers. All right, depending on the arrangement between Ballerina and the supplier. So we cannot really compare whether this is okay or not. However, if you delay payment to your supplier, this may erode confidence in the company. This may erode confidence of the supplier on the company, because the company will be seen as not creditworthy. All right. But in any case, how do you then reduce? Because when you delay payment to supplier, you are using the money to run your business. You are supposed to pay your supplier in 1 month's time. That 1 month passed, you did not pay. 1 month is going to 1.5 months, going to 2 months. You are using the money that you're supposed to have paid to your supplier. You are using it to run your own business. The supplier will not be happy with that for you to delay their payment. They will not be happy. Next time, they will not give you credits. Next time, if you want to buy, they will ask you to pay cash, and this may have financial implication on your business. All right. So let's see how we can reduce the trade payable. All right. Payment to supplier or creditors could be delayed. So that's what I'm saying here. If you delay payments, let's say, for example, your arrangement with the supplier is for 30 days. You then delay for like 45 days. So that will help you. That will reduce the working capital cycle, because when you delay payments, that means your creditor's payment period will be longer. If your creditor's payment period is longer, then that will reduce the working capital cycle. However, there's an implication to that. Some of them have mentioned it. One of the implication is that supplier may refuse to supply in the future. They will not give you credit again. They will not give you credit. You have to keep. Supplier may only supply on cash basis. They will ask you to pay cash because you are not credit worthy. That means your reputation has been damaged already. This may be loss of reputation. This may lead to loss of reputation. All right. It will lead to loss of reputation, because if you delay because you are not credit worthy, yes, the supplier will never be happy with it, because it's also affecting them. They also need money to run their own business too. But because you delay payments, that means once they see you, they now be run. They will have the security to lock the gates. Tell him or her that we have closed. Tell that customer that is coming that we have closed. It's because you have bad reputation or bad relationship with them. That's why they are avoiding you. That's not good. It will not also end with them, because most of all these companies if they are in the same industry, they may be having meeting or workshop together. They will be discussing you. They will be discussing you that company, they don't pay on time. So because the other company is already aware that you are not paying on time, if you approach them for credit facility, they will not give it to you too, because they know that you have bad reputation. So if at all supplier is going to give you that credit, then they have to increase the price. That means you are going to pay at a higher cost. You pay a higher price for that. So supplier may increase price in the future if they still want to be dealing with you. So they will increase price. So these are the ways in which you can reduce the working capital cycle. All right. And these are the likely, of course, this is exam question. So these are the ways examiner can test you on the day of your exam. So you must ensure that you know what you are doing. All right. So please make sure you go through all of them. So let's have one more example under this before we move to the next one. Let's have one more example. Let me see. Oh, in fact, we have two more. Before we go to the, okay, let's solve this one first. Which one is this one? Okay, this one should be faster. It's only one period. So number 6. Yes, I need somebody to read illustration number 6 for us. Let me see. Let me call one of you. I don't want everybody to be talking at the same time. Yes, Lekon, can you read for me or for us?
Yes, sir.
Okay, sir.
Go
Okay.
ahead.
Questions 6A. As the management accountant of Panorama Limited, you are requested to explain to your chief executive the difference between the concept of overcapitalization and overtrading as they relate to working capital management. Question B. What are the symptoms of overtrading? Question C. The following data were extracted from the financial statement of Oregon Limited. Required. Using the above data, calculate the length of cash operating cycle that is currently applicable to the company's operation for guidance of the management. You assume that all sales and purchases are on credit.
All right. Thank you very much. So, examiner is asking you in the A part of the question, you are asked to explain the concept or to explain the concept of overcapitalization and then overtrading as they relate to working capital management. When you talk about overcapitalization, overcapitalization simply means the company has excessive working capital. There's so much assets in the business, so much current assets in the business with little liability. All right. So when a company has capacity to conduct a larger volume of activity such that there is an excessive current asset with little payables, then this will result to over-capitalization. This will result to over-capitalization. You can imagine your inventory is so huge, account receivable is huge. You have so much cash idle in the business. All right, then you have little account payables. So when this happens, because the company has so much capital in the business, then there's tendency for the company to be under trading because you have so much. So you are spending the money that the company is supposed to have invested in short-term marketable securities to earn revenue or to earn returns is being tied in the business because you have excessive working capital. All right. So when this happened, we said a company is overcapitalized. The company is overcapitalized. That means you have so much capital. You have excessive capital in the business, which is not good. Then the next one, the second one is overtrading. Overtrading will arise when a company is trying to do too much too quickly with little or no financial resources to conduct the business. So you are just running here and there. For example, as a company, usually a company that is overtrading is profitable. Customers are willing and ready to buy. There are demand for your product. But because you don't have money to finance the operation of the business, you rely so much on credit facilities. All right. So you are trying to do too much, too quickly, with little or no capital. So when this happens, the company will be you will be over trading. All right. So what are the symptoms? Okay, let me look for so that we can have more perspective. I don't need to come back again to be explaining over trading again. Let me just search. What are we given? Yes, Oregon. Let me search. Let me use Golden Book to explain that so that we don't need to come back. Yes. This is it. So difference between overcapitalization and then overtrading. Overcapitalization arises where a business is being financially equipped to conduct a much larger volume of trade than necessary. When you have excessive inventory, so too much of inventory, account receivable, cash, and few account payable, there will be an overinvestment by the company in the current assets because your current asset will be huge. Because your current asset is huge, that means they are going to have a low working capital turnover ratio because you have excessive current assets. So working capital will be excessive and the company will be overcapitalized or under trading. All right. The second one is overtrading. Overtrading is also known as undercapitalization. It's also known as undercapitalization. It represents a financial situation whereby a company attempts to conduct a larger volume of trade than it is financially equipped to do. A company is said to be overtrading when it tries to do too much too quickly with little or no financial resources at its disposal. So a business that is overtrading might be profitable, all right, but it can easily run into serious financial problem because of illiquidity. Because the company is not liquid, then there will be issue. You want to pay salary, no money, even though you are making sales, yet you cannot pay salary on time. You are making sales, you can't buy raw material on time. You depend on credit supply. These are issues. So these can cause serious financial repercussion to business when it is unable to settle its business creditors as and when due. Because if you are owing your supplier and you don't pay on time, that may impair your reputation. That may impair your reputation as a responsible organization. Then you want to avoid that. Now, what are the symptoms? So there will be low liquidity ratio. All right, there will be low liquidity ratio. That's the symptom of overtrading. Examiner is asking you, what are the symptoms of overtrading? So if you are trying to do too much too quickly with little capital, you don't have capital. You are just borrowing. You are taking credit here and there. So that means the company is not liquid. Of course, this will result to low liquidity ratio. The next one is that rapid growth in current assets and fixed assets. Yes. So there will be rapid growth in current assets as well as fixed assets. So rapid growth in turnover. All these are some of the symptoms if a company is trying to do too much too quickly. So the company will also rely heavily on bank overdraft facility. So every time you are reaching the overdraft limits, every time at times you even go above the limits given to you. You take credit above the limits given to you with your bank. All right. So it's because you are struggling to run the business. You are not liquid. That's why. So creditors payment period is getting longer. You are delaying payment to your creditors. You are delaying payment to your suppliers. So this will have financial repercussion on the business. So these are some of the symptoms of over trading. Therefore, let's then go to number C. Number C, you are asked to use the data to calculate the length of the operating cycle. So let me go to the working notes to do this. Solution. So illustration, which illustration is that? Let me check. Illustration 6, page 115, 111. Okay. The name of the company is Oregon. Limited. Number C requirement. We are to calculate operating cycle. Cash operating, examiner call it cash operating cycle. So you then say calculating cash operating cycle in days. So we then go back to the question and check what will be the component of the operating cycle. According to the question, we are given raw material of 140,000. We are given work in progress. We are given finished goods. We have debtors. We also have creditors. So that means we have all the components. So I can then come here. If I don't want to use the definition as the component, I can say raw material conversion period. Or if you like, you can say number of days raw material is held in store. Anyone you use, you are good to go. Number, just to be consistent, number of days raw material is held in store. Then number 2, length of time in the production cycle. That's finished goods conversion period. Sorry, work in progress. Raw material conversion period. Then the third one is finished goods. Number of days, finished goods, are held in store before going into production. That's finished goods conversion period. Number 4, number of days credit is given to customers. That's debtors collection period or debtors conversion period. Then we have gross cash operating cycle. Then you then less number of days credit is taken from suppliers. That is creditors payment period. All right. So let's go and do working now. Working number 1. We want to determine, we only have one period, so no need to do table. So the first one is raw material conversion period. We said raw material conversion period is calculated as raw material over purchases multiplied by 365 days. So according to the question, we are not given number of days for a year. All right, examiner did not tell us. So we are at liberty to either use 365 days or 360 days for a year. So raw material in the question is 140. Purchases in the question is 560. So 140 over 560. 140 over 560 multiplied by 365. Lekon, what do you have?
91, sir.
91 days. Working number 2. Work in progress conversion period, which is computed as work in progress divided by cost of sales multiplied by 365 days. So, look on what's work in progress.
70,000. 70.
70 divided by cost of sales.
840.
840 multiplied by 365. Give it to me.
30 days, sir.
30 days. Working number 3. Finished goods conversion period, which is finished goods divided by cost of sales multiplied by 365 days. What you get? What do you have as finished goods?
160.
160. Cost of sales is 840. Multiplied by 365 days. What do you have?
70 days, sir.
70 days. Then we have debtors collection period, which is debtors over credit sales multiplied by 365 days. How much is debtors?
120.
120,000. How much is sales?
1,000.
1,000 multiplied by 365. Give it to me.
44 days, sir.
44 days. The last one is creditors payment period, which is creditors over credit purchases multiplied by 365 days. How much is creditor?
84.
84,000. Purchases?
560.
560 multiplied by 365 days. Give it to me.
55 days.
55 days. All right. Now that we have computed all the components, we have computed for all the components of our working capital cycle. Then let's go and put it in the table. The first one is 91 days. So here will be 91, followed by 30, then 70. 30 days, 70 days, 44 days. Add it up. Hey, come, add it up.
Okay, sir. $235 days.
235 days. Here is 235 days. You then less number of days credit is taken from supplier, which is 55. 55 days.
180, sir.
180 days. So you take this company half a year to convert raw material to cash. For the company spend money to purchase raw material. The raw material is converted to work in progress. From work in progress to finished goods, customer buy, and the company collects the money back. It takes the company 180 days. That's too long. This is net cash operating cycle. So you need to know all of this. You can see it's not difficult. So, but no matter how cheap is a question, if you don't know, you don't know. Yeah. Yes. Temitope, ask your question. Go ahead.
Yeah, thank you, sir. Like the way you are doing this question, so I'm also relating another question with it. So I think we were asked to calculate a director hypothesis proposal. Like, I just understand that I was being given 30%, like the way we calculate this equity and debt stuff. I think we were given like 50% to calculate the director's hypothesis. Like, is it the remaining 50% we use to calculate it? Because I don't get. I need you more light.
Director hypothesis. What is director hypothesis?
Like, it was the last diet question that I saw that we are being asked to calculate that.
To calculate director hypothesis under working capital. Talk to me, Temitope.
Yes.
Under working capital.
Yes, so let me check the question.
All right. Don't worry, you can share with me. That means in our next class we'll look into that. I've seen last year that question on the financial management and performance management. It's not under working capital. But in any case, share with me. I will look into that. All right. I have the director hypothesis. That's strange. No worry, just share with me. I will have a look. All right.
I think the question is that for hypothetical figures.
Hypothetical figures.
Yes.
So that means in the question, they've already given you the hypothetical figures. What the director is just, it's not an actual figure. They just assume some figures. They now ask you to maybe to use those hypothetical figures. So when you say hypothetical figures, they are just random figures. Do you get? But again, like I said, I will look at the question again. Then if it's under working capital management, then I will ensure that I solve it in class. All right. So, but for now, let's move on. So that's end of the question. So there's one more area I want to touch. There's one more area I want to touch under the working capital cycle. However, before we do, which is working capital ratio. Before we discuss working capital ratio, before we calculate question under working capital ratio, let's have a discussion around working capital ratio. Let me go back to your learning material. I want to see if you have working capital ratio there. Okay. We have to move faster because my plan is to finish all the underlying concepts so that in our next class, we do inventory management. I want to see if we have working capital ratio here, because examiner can ask you to calculate working capital ratio. I doubt if you have it here. Let me see. Working capital ratio. Majorly, there are three components of working capital ratio. We have a current ratio. We have acid test or liquid ratio. Then we also have working capital turnover, which is sales to working capital ratio. Those are the three major components of working capital ratio. So the working capital ratio is the matrix designed to assess the liquidity position of a business. So it's not here. Let me check Golden. I should have it in the Golden Book. Let me see. So working capital ratio is a matrix. They are metrics designed to assess the liquidity position of a business. And then majorly, like I said, there are three components of working capital ratio. We have current ratio, okay? We have current ratio, we have liquid ratio, as well as working capital turnover. So I want to use, so that I don't waste time, I want to use the golden book to explain that. Yes, this is it here. I have it there. So working capital ratio. These are metrics designed to measure the liquidity position of a business. A working capital ratio shows how well a company is meeting its short-term debts and financial obligations as they become due. So in determining the working capital ratio, information about statement of financial position should be used. All right. This information you have in the balance sheet of the company should be used to assess or to measure the liquidity position of the business. Majorly, there are three common working capital ratio. We have current ratio, quick ratio, and sales to working capital ratio. Mr. Asiwaju has taught you, Mr. Asiwaju and Mr. Wasi Opola in financial management. Mr. Asiwaju has taught you financial statement analysis, ratio analysis. Mr. Wasi Opola under financial reporting has also taught you the ratio. So this is just to measure the liquidity position. All right, so I don't need to waste time discussing that you have been taught already, but let me just brief you a little bit. What do you mean by current ratio? The current ratio measures the relationship between the current asset and the current liability. It shows the degree to which current assets can cover the short-term creditors. All right, it shows the extent to which current assets will cover short-term creditors. All right, so how do you then compute current ratio? Like we said, current ratio is the ratio of current assets to current liability. When you compute your current ratio, you are expected to interpret your results. Therefore, how do you interpret your results? The higher the current ratio, the greater the margin of safety for short-term creditor. That is, the higher the current ratio, the higher the liquidity position, because a higher ratio indicates a higher level of liquidity. A higher current ratio indicates a higher level of liquidity. So if you have a current ratio of 1 to 1, all right, you have a current ratio of 1 to 1. This means that the value of the book value of the current assets equal the book value of the current liability. That means what you have as your current assets can only cover your current liability, nothing more. Such company cannot be liquid. All right, because your asset is the same thing as your liability. That is not liquidity. All right. However, a lower current ratio will indicate less liquidity. So this ratio will vary from industry to industry. Current ratio varies from industry to industry, but the average standard worldwide, the average standard is between 1.5 and 3. So your current ratio on the average should be between 1.5 and 3. Some can say ratio 2 to 1. There's no specific ratio in the acceptable ratio. All right, so it varies from industry to industry. So you can say the acceptable ratio, which vary from industry to industry, can be between ratio of 1.5 to 3 for a very sound businesses. For a very sound business. All right, so that is current ratio. The next one is quick ratio, which is also known as acid test or liquid ratio. It measures the ability of a company to meet its short-term obligations using the most liquid assets. The most liquid assets are those assets that can easily be converted to cash. All right, so those assets that can easily be converted to cash, some of those liquid asset are cash and cash equivalents. Cash equivalents are those assets like a treasury bill, bankers' acceptance, okay, commercial paper, all right, federal government bond. You can easily sell them and get your money back. That means they are liquid. You can easily turn them to cash. So those are the assets that can be that are liquid. So the asset that is not liquid in a business are inventory, because inventory is something you are going to sell to the customers. So you cannot predict how long that will take you. And that's why usually when you are calculating a quick ratio, when you're calculating acid test ratio, you don't include inventory. So like I said, the quick ratio measures the ability of a company to meet its short-term obligations using the most liquid asset. It is calculated as current assets minus inventories over current liability. That will give you the acid test ratio. Then, how do you interpret your results? Quick ratio is more conservative than the current ratio because it includes only the more liquid current assets relative to current liability. All right, so I've already explained this. Liquid assets are those current assets that can be quickly converted, okay, into cash at close to their book values. So how do you then interpret it? Liquid ratio, it is an indication of a company's financial strength or weaknesses. All right, financial strength and weakness or weakness. It shows how much of the company's available liquid asset that can be used to offset the short-term debt obligation at a very short notice. All right, so the higher the quick ratio, the better the liquidity of the business. So the ratio between 1 to 2, between 1 to 2 or 1.5 to 2 is okay. If you have between 1.5 to 2, that's okay. That doesn't mean that if you have ratio 1 to 1, it's still reasonable because you've already deducted your inventory. So the balance of your assets versus your liability. So if you give you 1 to 1, you're still fine. All right, but to ensure adequate liquidity, then ratio of 1.5 to 2 is more reasonable. All right. Then the last one is working capital turnover, which is also known as net sales to working capital ratio. It measures how judiciously and efficiently a company uses its working capital to generate sales and growth. All right. You want to know how is the company using working capital to support sales and for growth and expansion. All right. So sales to working capital ratio measures the naira amount of working capital that is used to generate sales. How much working capital are you used to fund sales? That is what the working capital turnover ratio measures. So it is computed as net sales over working capital. When you talk about net sales, all right, when you talk about net sales, when you make sales, you want customer to pay on time. You give the customer discounts. So that means your sales will reduce. When you give customer discount, your sales will reduce. Not only that, when customer buys your goods, it is possible maybe due to defect or some other things, customer may return. So that's what we call sales returns. So these sales returns supposed to be deducted from the sales, from the original sales. It is also possible you can make a sales commission maybe to your sales executive or to marketing team that if you're able to sell so much quantity of these products, you are going to earn a commission of 5%. So that when you give that commission out to your sales rep, that will also reduce your revenue. So all these costs, all the sales revenue plus commission plus the discounts, when you add them together, you less it from your gross sales. That will give you your net sales. You then go ahead to calculate your working capital. And you know already that working capital is current asset minus current liability. So at the end of the day, when you are done computing your working capital ratio, you are supposed to interpret your results. So a higher working capital turnover ratio is better. The higher the working capital ratio, turnover ratio, the better for the company. Okay? So which simply means that company can generate more sales through investment in working capital. That is, working capital is supporting the sales and is supporting is supporting the working capital is supporting sales and the growth. But a lower working capital ratio, turnover ratio, indicates that the company is over investing in working capital. There is excessive working capital. So there is excessive working capital. When you have excessive working capital, the ratio will be very low because the denominator is huge, but the numerator, which is the net sales, is very small. So many factors can result to that. It may mean that the company is not generating sufficient sales. It means for the company to be able to overcome the low working capital ratio, the company may embark on what we call aggressive marketing, so that you have so much sales. When you have much sales to make, then of course that will also improve the working capital turnover ratio. So when a company have excessive working capital turnover rate, when you have too much of working capital turnover ratio, right? So it means that working capital is low and the company needs to raise additional capital to support sales. So each of them, whichever way, you have to find a way of interpreting when you compute your working capital turnover or net sales to working capital ratio, you must be able to, and any other metrics under the working capital ratio, you must be able to interpret your results accordingly. All right, so that's that. Let's have one more illustration under this. Let's have one more illustration. Let's go back to your learning material. Okay. Which one is this? Yes. I want us to solve a question that involves working capital ratio. Let me see. Yes. Let's solve this illustration number 8. Illustration number 8. That is that's page 112. Yes, let me look out for one of you to read this. Adiola, you want to read it? Adiola?
Sir?
Yes, read it. Illustration number 7.
State and
Sorry,
explain
hold on. Not illustration number 7. I think illustration number 8, I said. Illustration number 8. Thank you. Go ahead.
List 5 relevant factors that determine the working capital requirements of a firm. B. The management of Ayetoro Nigeria PLC desire to review their working capital management policy and has presented the data stated below to you as the newly employed management accountant. In order to assist in taking a meaningful decision, the following data were given: current assets, stock,
Leave those
debtors.
ones.
Okay. Purchased during the year were okay. You are required to calculate 1. Sales or working capital ratio. 2. Current ratio. 3. Quick ratio or assets ratio. 4. The operating cycle for the working capital.
All right, thank you, Della. So you have to wait behind. When we are solving, you'll be giving me the numbers. So in the first requirements, you are to list 5 relevant factors that determine working capital requirement of a firm. So we are going to use this, instead of me to go and be explaining again, what are the determinants, or what are the criteria, what are the factors that inform the working capital requirements. So we're going to use this question to do that. So examiner is asking you here to list 5 relevant factors that determine the working capital requirement of a firm. As a company, what are the factors you should consider before you determine how much working capital you are going to need to run the business? So those factors are what we want to discuss. So what are those factors? Number 1 is business cycle. Okay, let's do it this way so that it will be faster. Let's use the Golden Book. Let me turn to Golden Book. Let me know if you can see if I'm sharing Golden Book. Am I sharing Golden Book? Confirm for me, please. Diola, what are you seeing on your screen? Is it Golden Book or the class learning material?
It's the Golden Book.
Okay, thank you. What's the name of the company again? Let me see. Ayetoro. Let me see if I have Ayetoro. Yeah. Yeah, you don't waste my time. Okay. Ayetoro is not here. I guess I've used another name. Let me check. Okay, let me just go by a little bit. I want to use, this is it here. Now, examiner can ask you, just like in this question, somebody is sending a chat. Page 332. Oh, okay, thank you. I think I used another name. That's why I've come back to that page 332. Now, this is it here. So examiner is asking you to list relevant factors, right? List 5 relevant factors that determine the working capital requirement of a firm. What are those factors? What are the determinants of working capital requirements? What are the factors you should put into consideration for you to know this is how much working capital that is needed to run the business? All right, so that's what the examiner is asking you. It's not just about listing them. The fact that examiner says you should list doesn't mean that you are not going to explain each of them. Because you can't just say business cycle, companies' credit terms, all right, suppliers' credit policy. You can't just say that is not sufficient. Examiner will just give you half. You can't earn your full mark if you do that. You need to explain what each of you list, then you explain it for you to be able to earn your full mark. So this is how I explain this. Working capital requirements generally influence the liquidity position of an organization, and it is dependent on several factors. Let me even check the 332 that's somebody called my attention to 332. Let me see. 332. I just want to be, okay, 3 more. 332. Yes. Okay. So because the examiner says you should list, you can hear I just listed it. So that is not sufficient. Like I said, you need to explain. You can't just say business cycle, business environment, name and nature and size of a business. What do you mean by that? So that doesn't mean you are not doing the right thing, but you need to explain them briefly. You need to explain them briefly. What do you mean by business cycle? All right. What do you mean by nature and size of the business? What do you mean by seasonality in operation? All right. So that's what I'm trying to explain here. So when you talk about business cycle, there are different cycles in a business. All right. There are different cycles within the economy. In the business environments, different factors affect the business operation. For example, you can in the external environment of the business, we have what we call there can be a factor such as economic, political, legal, and technological that can affect the operation of the business. So, for example, during the boom period, all right. So there will be more customer will be willing to buy more to buy more goods and services. The customer will want to buy goods and services during the period of boom because the economic is good. Everybody has the standard of living is high. So people can buy things they like. So during that period, of course, more working capital will be needed because companies are generating sales. So more working capital will be needed to purchase raw material during that period. So you need to compare this to when there's contraction or when there's recession in the economy. You know, during recession, money is hard to get. Customers are not buying things. They are not patronizing. They are not buying goods or services because the economic is hard. Therefore, during this period, the company will need less working capital. The company will need less working capital. So that is what we are trying to explain here under business cycle. So business cycle represents the kind of the trend, the economic condition during a particular period. And these cycles usually affect, these external factors usually affect the business. So when there is boom, when there's economic boom, there will be more working capital needed to fund the operation of the business. But when there is recession, less working capital will be required. So that is the explanation of business cycle. The next one is nature and size of the business. So working capital requirement is different from industry to industry. For example, the working capital that a manufacturing company will be needed is different from the working capital that a service company will be needed, because a manufacturing company will need inventory. A service company does not need inventory, right? So the size of the nature of the business in terms of, is it manufacturing company or a service company? So manufacturing company will need more working capital relative to a service company. Again, when you talk about the size of the business, the bigger the size of the company, the bigger or the higher the working capital that will be needed, and vice versa. For example, Dangote PLC, for example, right? The kind of working capital that the size of Dangote will need, it will be different from the working capital the smaller manufacturing company will need. It's not the same thing. For example, now for equity professional, we have three we have operation in Isolo, Lagos. We have online operation as well. So the kind of working capital that equity professional will need will be higher than the working capital that an operation and a tuition center that has only one location. Because we need money to pay, we are going to pay salary, we are going to pay lecturer's fee, right? For each of the segment, equity professional will pay lecturer's fee. But a tuition center that has only one location, we only pay one lecturer's fee. But we as equity professional, because we have three different locations, that means we are going to pay more lecturer's fee. Not only that, when you are lecturing, you are going to need marker, right? Let's say in our VR center, we use marker. In Solo, we use marker. So these are supplies. That means we are going to need more money. We are going to need more working capital to purchase markers relative to center that has only one location. Because you cannot use the same you can't use the same marker for VI to go and lecture in Isolo. It's not. So the larger the size of the business, the larger the working capital that will be required, and vice versa. This is what we are trying to explain for nature and size of a business. The next one is price level changes. Price level changes simply means inflation. So during the period of inflation, company generally will invest more in working capital because more money is needed, more cash is needed to purchase inventories. Because we are saying that the purchasing power of the money has declined, has fallen. Because the purchasing power of money has declined, then you are going to need more money to purchase raw material relative to when inflation or when price is stable. When price is stable, you don't need the money you are going to, your working capital requirement will be relatively stable as well. But when prices are changing every now and then of course, this will mean that more working capital will be needed to purchase raw material. So the next one is firm's credit policy. What is the company's credit terms? So a company's credit term also affects its working capital level, right? If a company is liberal or generous, okay, in terms of credits given to customers, so that means more investments will be needed in working capital. So if you are that kind of Father Christmas company, a company that is so liberal, if your credit term says 30 days, 30 days will pass, your customer will not pay, and you don't care, right? That means you are Father Christmas, you are very generous, you are liberal. So that means you are going to need more money to continue to maintain your working capital level. But a company that has a strict or tight credit policy, then such company will need very minimal working capital. All right. So because you don't give too much credit time for too much days for your customers to pay, maybe maximum 3 days, you've collected your money, you monitor them, you ensure that they pay. Customers do not delay your payments. So that means you have a very tight working capital policy. All right. So depending, your working capital requirement will depend on the firm's credit policy. All right. The next one is availability of credit from suppliers. Okay. So if your companies will need more cash to purchase raw material and other supplies, if the supplier has a restrictive credit policy, if your supplier does not give you much credit, much window for you to make your payments, then that means you are going to need more working capital to purchase raw material. But if you also have a liberal supplier, a supplier that will give you longer time to make your payment, then in that case, the working capital requirements may be low. All right. Then let's add one more. The next one is growth and expansion. Growth and expansion. So more working capital will be needed when a company is growing, and then when the company is growing. So like I explained the other time, for equity professional, we have operation in VI, physical operation in VI, we also have in Isolo. We also extended to online programs, online lectures. So that means equity professional is expanding. It's expanding. All right. So as a result, more working capital will be needed for a company that is growing and expanding. More working capital will be needed. So when a company is growing, more cash will be required to purchase inventories. So like I mentioned the other time, equity professional will need more cash to purchase, to buy supplies like marker and any other stationeries that we need to run the day-to-day activity of the lecture center. All right. So that is what we are saying here as per the growth and expansion. So these are the factors, these are the criteria, these are the determinants that are required for determining working capital requirements. We can also talk about seasonality. Just read it through. So because of time, so let's solve the B part of the question. So the B part of the question is asking us to calculate working capital ratio. All right, working capital ratio. Let's quickly use our working notes to do that. This is solution to illustration 8. I think page 112. Let me confirm. Page 113. Yes, 112 rather. Okay, so we want to calculate sales to working capital ratio. Because our time is almost up, let me just use the golden book. No need. Let me use the golden book. Let me use the golden book to explain that. I've already solved it there, so it's the same thing. Let me just, what did I say is the name of the company? Say 332. Somebody said 332 the other time. We're almost there. 332. So in our next class, by the grace of God, we are going to do inventory management. Inventory management, where we talk about EOQ, inventory costs, then inventory levels. All right. Okay, this is it. Yes, I changed the name of the company to Oliveira. Yeah, instead of Rego, zero Rego. So in the B requirement of the question, number one, you have to calculate sales to working capital ratio. And we said that sales to working capital ratio is also known as working capital turnover ratio. And we said working capital turnover ratio is the ratio of sales to working capital. That is, to calculate sales to working capital ratio, you divide the sales with the working capital. So we then go to the question, how much is the sales value? According to the question, sales value is 168 million naira. Okay? The sales value given to us is 168 million naira. So then working capital, we are not given working capital in the question, so we need to go and calculate working capital. And you know that working capital is equal to current assets minus current liability. So you then go to the question, how much is current assets? So according to the question, current assets, when you are calculating working capital, you don't include cash. But this is just financial management. If you want to, under this topic, if you include it, examiner will just mark it for you. But ordinarily, when you want to determine working capital, you don't include the cash. All right. So let's say this our working capital 53,640. All right. Then that's our current assets rather. Then current liability is 10,080,000. So the difference between the two will give us 43,640. 43,640. So when you less, so here I have 43,560. That means I've deducted cash. So let's see working for my, yes. So this is the working capital, 53,640 minus 10,080,000. So that's what gives us the 43,560. So if you remove current assets, like I said, when you are calculating your working capital, we don't include cash because you already have the cash, so you don't include it. But if at this level you include it, no worry, examiner will mark it for you. All right. So when you now divide 168 million by 43,560 million, 43,560,000, we have ratio 4 to 1. Ratio 4 to 1, that is 3.9 to 1. Can you say this is reasonable? To a large extent, all right? There is no threshold. There is no threshold for working capital turnover ratio. There's no specific threshold. But the bottom line is that your working capital turnover ratio should not be too low and should not be too excessive. All right. Next one is current ratio. We said that current ratio measures the relationship between current asset and current liability. It is computed by dividing the current assets with the current liability. So we then go to the question. Current asset is 53,640,000. Current liability is 10,080,000. So when you divide, we have ratio 5 to 1, that is 5.3 to 1. This appears too excessive. There's too much investment in current assets. Ratio 5 to 1 is too much. It's just too much. Remember, the most acceptable standard worldwide, depending on the industry, is between ratio 1.5 to 3. So if it is more than 3, that means it's excessive. So ratio 5 to 1 appear too excessive for me. All right. Then the third one is quick ratio, which is also known as acid test or liquid ratio. So, which measures the relationship between the liquid assets and the current liability. So, quick ratio is computed as current assets less inventory over current liability. So, the current asset in the question is 53,640,000. Inventory in the question is 21,600,000. You then divide by current liability of 10,080,000. So we have ratio 3.2 to 1. Again, despite reducing the inventory, you still have a huge liquid ratio. All right. So ratio 2 to 1 appears okay. But if it's going to 3, that's too much. So that's what examiner wants you to do in the B part of the question. In the C parts, you have to determine operating cycle. You want to calculate operating cycle. Therefore, how do you compose the operating cycle? You go back to the question. The information you have in the question will tell you how much, the number of items you are going to have in your operating cycle. In the question, we have raw material of 21,600,000. We have debtors of 32 million. We also have creditors of 10,080,000. You only have 3 components of your working capital cycle instead of 5. You only have 3. We don't have work in progress. We also don't have finished goods. Therefore, it is only the one you are given in the question that you are going to calculate for. So we need to calculate raw material conversion period, which is raw material over purchases. Purchases in this question is 105,120,000 naira. Sales is 168 million. So quickly, to calculate, we go and do our workings for raw material conversion period. Like I said, it is raw material over purchases multiplied by 365 days. So raw material in the question is 21,600,000. Purchases is 105,120,000 naira. So multiply by 365 days. So we have 75 days. Again, in the question, we have debtors of 32 million. So that means we need to calculate debtors collection period, which is debtors over credit sales multiplied by 365 days. So we are given debtors of 32 million naira. We are given credit sales of 168 million naira. So you multiply with 365, we got 70 days. All right. Then creditors payment period, which is creditors over credit purchase multiplied by 365 days. According to the question, creditors, the total creditors is 10,080,000 over credit purchases of 105,120,000 naira, then multiply by 365 days. This gave us 35 days. You can see that because this company is overcapitalized. This company, what's his name again? I think this one is Oliveira, right? The name of this company, yes, is Oliveira. In the learning material, the name of the company is Oregon. Is it Oregon? Ayetoro. It's Ayetoro in the class learning material. So this company is under trading. That is, the company is overcapitalized, and that's why we are seeing huge current assets. So you can see We calculated raw material conversion. It takes this company 75 days to convert raw material. Raw material stays in the warehouse for 75 days. You can imagine that. So almost 2.5 months. Okay. Debtors convert. It takes the company 70 days to collect money from customers, and it takes the company 35 days to pay suppliers. So that means the company is paying quicker to suppliers than the company is receiving from customers, because the company is overcapitalized. The company is overcapitalized. That's excessive current asset. That's why the company the current creditor payment period is low. So based on our calculation, our gross working capital will be 145. All right. When you less creditors payment period, then the net working capital cycle is 110 days. So the net working capital cycle of Oliveira Nigeria PLC is 110 days. So if in case examiner is asking you to advise, all right, for you to know whether these rates, whether these figures are reasonable or reliable, you need to compare with industry average. You compare with industry average and with the company's prior, with the trend. You carry out what we call trend analysis. You compare this with what the previous figures, all right, to know whether the company is doing well or not. And this should also be consistent with the credit policy of the business. Okay. So that's end of the question. Let me know if you have any question for me. This is where we are going to call it a day. Some of you have disappeared. That's okay. Majority of you are still on. All right. Let me see some of you. Let me check attendance again. This person that is using dash, I don't know your name. Yeah, Abdul Samil, representing VI, Adiola Isolo, Adedayo Alamutu. I have Adedeji. Oriseneye. Yes, Oriseneye, talk to me.
Sir, good afternoon, sir.
Good
Sir, you
afternoon. How are
said,
you?
fine, sir. You said if we want to know how to comment on our workings, that we should use trend analysis, right, sir?
Yes.
So how are we going to do the trend analysis? Because
No,
I don't think
what I
I
mean
can
by
see it.
what I mean by trend is that, previously earlier today, we calculated for we calculated for ballerina, right? We calculated working capital cycle for ballerina. Let me check again. We did for 2012, 2013, and then 2014. So you just compare. In 2012, how much was our working capital cycle? In 20 should not buy. Let me check. Let me search for ballerina so that it will be clearer for you. Orisenaya. Ballerina. Ballerina. Okay, this is it here. Is it this one? No. Yes. Oh, I'm using that one does not have solution. Ballerina. Let me use the golden book to explain, to show you that. Okay. So, Orise, can you see my screen?
Yes, sir, I can see your screen, sir.
So this is what I mean by trend. So in 2012, we calculated working capital cycle to be one. Oh, my pen has stopped. We calculated working capital cycle to be 167, right? I'm using mouse. My pen has stopped. Then in 2013, we calculated 194, right? Then in 2014, we calculated 196. So this is what I mean by trend analysis. So you are comparing your previous results with the current result to be able to know whether you are doing well or not. So you can see now, when you compare 2012 to between 2012 and 2013, you see that this company working capital cycle is increasing, because in 2012, working capital cycle is 167. In 2013, it has increased to 194. And you know that the shorter the cycle, the better for the company. But in this, for Ballerina, the working capital cycle is increasing, which is not good. So that's what I'm trying to say by saying that you can carry out trend analysis for you to be able to measure whether the company is doing well or not. You compare the current figure with the previous figure. That's trend. You can also compare the company's figure with competitors' figures or industry standard. So all this kind of analysis is what if examiner wants you to do all of that, you are going to be given the benchmark, what you can use, whether it's industry standard, or industry average, or the company. Like in this case of Ballerina, now examiner can ask you to comment on the working capital cycle, whether the company is performing well or not. So in this case, you need to compare year on year, 2012 versus 2013 versus 2014, whether the company is doing well. This is trend analysis. Is it clear now, Orise?
Yes, yes, sir.
All
Thank
right.
you, sir.
You are welcome. So somebody is saying, okay, page 330. Thank you. Yes. So let me just check your attendance again before I let you go. I want to thank every one of you that waited behind to this minute, even though I've extended your period beyond the 4 o'clock. All right. I see you, Samuel, Adiola, then Adedayo. I can see Adedeji Adebayo. I can see Olamilekan. I can see Olamilekan Adejimi. Yes, I can see Adeola. Adeola is representing VI. I can see Adewale Kehinde Raphael. That's online. Real one, Ado. Yeah, that's VI. Anna, I think Anna is Anna. Is it Anna in VI? I don't know. Yes, I can see Arafat. Arafat is Isolo. Rebecca Ashaye, that's Isolo. Chidera, online. Chizon, VI. Chizon, baby. Thank you for your support. I've not heard your voice today. Oh. Are we quarreling? You did not greet me. Chizon, are you there? Let me hear your voice.
Yes, sir.
Chizon, are you there?
Good evening, sir. Yes, I'm here.
How are you?
Hi, sir.
Yeah. So I can see Costello representing Isolo. Imem, I think Imem is online. Baraka, Faraway. Is it Faraway? I've been wanted to ask you, Baraka. Is it Faraway or Faraway? Baraka, talk to me. Let me hear your voice. Or are you represented by proxy? Anyway, yeah. Somebody is sending. Femi, did I ask you? Are you Baraka? Is it far away, Femi? Yeah, okay. Maybe she's
Far away.
Far away, Barakat.
Okay, far away. Okay, far away. All right then. Then I have Florence Ogbebo. I have Frances representing VI. I have Glory Ijoma Islamia representing Isolo. All right. Joy Adigbite. Kauthar Omolabake. I can see Lanre representing VI. Martha representing VI. Miriam Abdullah. I think Miriam is in VI too. I think I have so many of them. Yes, I can see Matthew Ola. Matthew is in, I think it's solo. Yes, Michael Ame is solo versus online. Michael Adebayo online. Nandi Nilan, that's my online person. Samuel, I can see Neka, Noye, Nuriyat, that's Isolo. Ogini Olamilekan online. Ojediran Oluwatosin. Yeah. I can see Olaide. Okay, Dele. That's Isolo. Oluwafemi Oyebode. That's Isolo. Mercy, Oriseneye, online. Yes, I can see Periside. I can see Phyllis. Those are my online people. Rekia, Isolo. Ruth. Shante, Isolo. Shante. Shante, how are you? Talk to me. Shante, baby.
I'm fine, sir.
How are you today?
Good afternoon, sir.
Yeah.
I'm fine, sir.
Yeah, Stephanie. Stephanie, talk to me.
Good afternoon, sir.
How are you?
I'm fine, sir.
Yeah, Temitope read for us today, so I've heard her voice. Taibat, how are you? Toriola Samuel. Yadasisi, representing online. Zoom user, then Zoom user. I have two Zoom users here. So talk to me. What's your real name? Zoom user 1. Yes. I asked you when we started. You did not mention your name. Okay. Zoom users, what are your names? Or no names? Okay, I will agree. Zoom user 1, Zoom user 2. So thank you everyone for waiting behind, even though I use extra minutes of your time to ensure we complete today's class. I really appreciate, and I didn't take that for granted. By
You're
the grace
welcome,
of
sir.
God, yeah, this is where we are going to continue in our next class. So in our next class, we are moving to inventory management. So thank you to every one of you. I will see you next time by the grace of God. And then for online students, we are meeting tonight to continue our class normal period 8:30 to 11. All right. So thank you everyone. Bye-bye.
You are welcome. Bye-bye, sir.
Thank you,
See
sir.
you. I will be calling you since. Baraka, I'll
Sir,
be
it's
calling
the
you since.
network. It's the network. I'm not
Thank
the
you
one.
for the class, sir. We appreciate
Sir,
it.
we
Have a
will
good
spend
night
our
and have a
sir
good
this
evening.
extra 20 minutes.
All
We will use
right,
it on
Larry. All right,
Yeah.
Baraka, take care. See you
Yes,
on
sir.
Sunday by
Bye-bye,
the
sir.
sir.
grace of God. Bye.
Extra 20 minutes.
Okay.
Give us back
All
on
right. Yeah.
Sunday.
So I have full time now, so we can get on
I
it.
gave,
So, like I said,
yes.
I was trying to say it's time to throw the floor open for every one of us, chip
The
in for it.
All right,
And
guys.
then,
Bye-bye.
oh, still on.
No, yeah.